Hello, welcome to this introductory video on taxation in Uganda, brought to you by Taxation Uganda. What this video is intended to do is to bring to your knowledge some of the most fundamental introductory concepts about taxation in Uganda in terms of its application and administration there. So this video could be of quite some relevance to various people, including practitioners. It could be of increased relevance to students and indeed taxpayers. So my name is Norman Inyang, who will be presenting to you as I've done in a number of the videos there about taxation in Uganda. So this will give you a much needed strong grip, as I said, on the introductory concepts. So we begin our discussion by looking at the key definitions there given rise to there under section 2 of the Income Tax Act. You notice we shall be making a lot of reference to the Income Tax Act because that is the law that governs administration of Income Tax Act in Uganda, of course administered by the Uganda Revenue Authority. There is an entity that administers income tax in Uganda and indeed most of the other taxes. So our very first definition we have is that of a person. So what do we mean when we talk of a person in the world of tax? Of course, up until today, our definition of a person, at least for most of us, it certainly can't be all of us, but for most of us, our definition and imagination of a person has been restricted to a human being, where, you know, so and so is maybe a hardworking person, so and so is a courteous person, so and so is a nice person. But that may form part of the definition of a person in tax, as you can see here, but it is not all, because according to the Income Tax Act, a person may be an individual or an entity. So the entity we are talking about can be a partnership, it can be a trust, it can be a political division there, or it can be a listed institution. So that is quite important for us, because throughout our discussions of tax, we shall be making reference to a person. So at least the important takeaway is that we now know that a person can be an individual or an entity. That one will be a tax person. The second definition is that of a taxpayer. The word taxpayer is also used quite frequent in tax practice. For example, we have the taxpayer identification number, which is used there quite often, the 10-digit number that is used by URA to administer tax there for the last so many years there. So who then is a taxpayer? A taxpayer, still according to our section 2 of the Income Tax Act, means any person who derives an amount subject to tax under the Income Tax Act. So another important addition we have there is that a taxpayer also includes any person who incurs unassessed loss for a year of income. So a little bit of deviation there from what would have been a layman's definition. When you say taxpayer, doesn't necessarily mean somebody who is paying tax or has a liability. So even if you incur unassessed tax loss, you're still included there in the definition for taxpayer. The third very important introductory aspect we have here is that of the year of income. So the year of income means the period of 12 months ending on on 30th June. So a little bit of a default date there coming in from the Income Tax Act. So that the year of income is the 12-month period ending 30th June, and also includes a substituted year of income and a transitional year of income. So two introductory words there. But before we go to the substituted year of income and transitional year of income, it is important for us to note that the year of income by default ends on 30th June. So if you apply for a taxpayer identification number, the automatic accounting date that will be used will be 30th June, because the accounting date is the last day of the year of income. But the default year of income for every taxpayer in Uganda, at least by the current income tax law, is 30th June. So what then is a substituted year of income? A substituted year of income is a 12-month period, just like the year of income, but a 12-month period other than the normal year of income. So a 12-month period other than that ending 30th June. I want to give an example. If, for example, you run a school and your school calendar probably runs from maybe first term starts from around February to around May, then second term maybe starts from early June up to late August. Well, at least those have been the days before some of the dates before the unfortunate interruption of COVID-19 there, where lots of school terms change. But let's look at the old conventional period. So you are in a situation where your second term is running from June up to August. So, but the financial year also ends at the end of June. So if we are to go by the conventional year of income, so it would lead us to quite some cumbersome work if we were to prepare our tax returns up to 30th June, because clearly you see that second term will be quite split in there between the two financial years, and as such it would lead to quite some cumbersome work in making the apportionments there and preparing the final accounts. On the other hand, it would be quite easy if we were to prepare our tax returns from January to December, because straight away, going by our education calendar, you definitely have first term, second term, and third term all in the same financial year there. So that is our definition for a substituted year of income. You may also have an NGO whose donors, for example, take an example of a donor based in the United Kingdom would prefer to send grants in the year ending 31st March. So you'd be getting your grants probably from 1st April to 31st March. Again, it would create a lot of work if this team was to prepare returns by the conventional year of income. So that is stated in section 39 of the Income Tax Act for those who may be interested in doing further reading and indeed having a strong grip on some of these introductory concepts, which of course will form a strong foundation there out of it. So section 39 looks at those, the provisions for the substituted year of income, 39 1, 2, and indeed 3. Maybe another important takeaway here is that that is mostly provided for under section 39. You may also notice that there are certain conditions that are provided for by the commissioner, so you have to fulfill these conditions. Otherwise, it is his right whether to grant a substituted year of income or not, or even revoke it. So the substituted year of income is a privilege, I must emphasize. It's not a right for for any taxpayer. But given a convincing reason, I think most likely the commissioner would grant it. Of course, there are other unconvincing reasons, but of course, those are at the discretion of the commissioner there. So that forms our basis for substituted year of income. Let's look at a transitional year of income. So this is also given rise to by section 39, mostly subsection 6. So a transitional year of income is a period where now you're changing from the conventional year of income to the substituted year of income. Take an example. You're a school, you registered for your TIN or with URA, tax identification number there, and then now you're trying to move your accounting date from the conventional year of income. Sorry to use the word accounting date, although they are quite related, but I wouldn't want to throw in so many terms here at a go. So assuming that your year of income was 30th June initially, now you want to move to 30th December. So what will happen is that the first your first year for you to transition from a period ending 30th of June to a period ending 31st December, there will be that period, that short period of less than one year, in this case 6 months, running from 1st July to 31st December. That is your transitional year of income. It's a transition in the most basic way. It's just a transition. So you're changing there from probably a conventional period to a non-conventional period. By the way, it may also involve when you're changing from a non-conventional period to a conventional period. If, for example, you've been filed, you're moving from a substituted year of income to the normal year of income, you'll definitely have a transitional year of income. If you're moving from the normal year of income to a substituted year of income, you'll also have a transition year of income. Let's take an example of the NGO whose substituted year of income was ending 31st March. Assuming they are moving from 30th June to 31st March, what would they do? They would have a 9-month period from 1st of July to 31st of March to catch up with the other year of income, and then all the other years they will now be going from 1st of April to 31st of March. So that is what is involved in a transitional year of income. So once again, the opportunity is there to do additional read up under section 39 of 39 subsection 6. Basically talks of what we have already discussed, but once again will improve your grip on some of these very fundamental concepts. Next, we look at the impact of change on tax compliance. What then is the impact of the change of the year of income, maybe to a substituted income? So we basically expect that this will change the time at which a company, I should have also added individual, is required to pay their tax installments. So if, for example, maybe I'll just use an example of a company. The law provides that companies pay their taxes, their provisional taxes, in 2 halves. That is 6 months from the starting date of the accounting, of the year of income. So if then, for example, your period is now starting from, if it were the conventional 30th of June, you'd be expected to pay the first installment by 31st December. Note that I didn't say on, but by 31st December. The next installment would be by 30th of June. But if eventually you change your year of income to a substituted one of maybe 31st of March, you are then expected to pay your installments there for provisional 6 months from your commencement date of 1st April, and that is by 30th of September. And also your second installment will be by 31st March there. So a little bit of something for us to look forward to there if we are doing tax advisories there or tax compliance checks. So the next is we look at now how then is income tax imposed. How is income tax imposed in Uganda there? So we notice that income tax is imposed on every person. Of course, now our definition for person is that from a tax perspective. So it's imposed on any person who has chargeable income for a year of income. So the year of income can also be in the substituted year of income or the transitional year of income. Those are all year of incomes, even if it's different from the conventional year of income. So important for us to take note of in the definition is that the gross income of a person is the total income less the total amount of allowable deductions. So there are certain types of deductions which are allowable in tax. Certain types are not allowable in tax. Again, there are all sorts of principles and all sorts of provisions under the Income Tax Act to cater for that. For example, if you were caught driving at the express or probably on a highway at 200 kilometers per hour and you received a hefty traffic fine, well, that is a cost to your company, but will not be an allowable deduction. So we then note that not each and every expenditure, whether incurred or not incurred, okay, let's look at the ones incurred. Not each and every expenditure will form a basis for allowable deduction. So that is quite important for us there. And then maybe a small little takeaway about the gross income that may also happen. For example, if you have your amount, probably you got a payment less withholding tax. For purposes of income tax being imposed, we need the gross income. So that would then be the net plus the deduction. And then the tax computation would start from there. The next important takeaway is that income tax is for individuals and entities. So we don't have a thing as corporation tax in Uganda. It is still income tax, at least by the current law and tax administration there. So that's also quite important. And then the provisions for this chargeable income are under section 15 and 16 of the Income Tax Act. So once again, a little bit of additional reading there for those who may want to interface with this additional reading in these introductory concepts. So the next then we look at the tax rates. We want to look at the tax rates for both individuals and the entities, which we shall refer to as non-individuals. So this is stipulated under section 6 of the Income Tax Act that we use, and this is stated as follows. The chargeable income of an individual for a year of income is charged to income tax at rates which are prescribed at Part 1 of the third schedule. So we find the rate of individuals at Part 1 of the third schedule there. And also, it's very important for us to take note that the rates are not uniform. We have two types of individual tax payers. We have the residents and then the non-residents. The rules of determining residents and non-residents are a bit more detailed. I didn't want to say complex, They are simply detailed. So a little bit of an extra effort may be required in determining the residence or non-residence of certain taxpayers. But for a start, you'd expect the rates of residents to be more favorable than that of non-residents, logically, because their footing is basically here for the residents, but the non-residents probably they have a footing in another country that probably takes them as resident taxpayers. So in the next slide, we look at the various rates for the residents there. So you can see from the table that we have thresholds and increasing percentages. This, of course, makes payers you earn a progressive tax. Yes, indeed, a progressive tax that it is. So you can see that we have a tax-free amount, which is 2,820,000 there. So taxpayers in that category are not taxed. Those in the 2,820,000 Uganda shillings there, those ones are not taxed. And then it progresses as the thresholds increase. Then you have 10% increment there. And then on the higher end, we have two bands that are taxed above 4,920,000. The first one is the one of 30% there, where people are earning above 4,920,000 are taxed at 30% there. But also quite important for us is to take note of the higher band there, which taxes the income at 40% for those earning above 120 million in a year. It's quite a huge annual threshold there, maybe in the region of $35,000 there in a year. And then monthly, it will translate to about 10 million shillings. That is in the region of $3,000. So I must confess, not so many people in Uganda earn this kind of money. Probably it's a privilege for a few executives in most entities. So because of that, most taxpayers are not even aware this band exists, because it basically applies to the higher people at the real apex of society in Uganda. But anyway, it's provided for by the law there. So those are the bands for income tax in Uganda, from 0% to the highest band of 40%. Maybe another important takeaway from this is that pay as you earn also uses the same rates. And I repeat, pay as you earn, which is a monthly tax, uses the same rates. The only difference is that these are annual rates, and pay as you earn uses monthly rates. So all these rates are the same, except that the thresholds are divided by 12. For example, the first band of pay as you earn is 235,000, which comes out of 2,820,000 divided by 12. And also at the highest, at the apex there, you have those above 10 million Uganda shillings, paying tax at an additional rate of 10% from the 30%, so that is 40%. Those from those who earn above 120 million divided by 12, which is 10 million. So that's quite important for us. In the next slide, we look at the rates for non-residents. Straight away, you may notice some similarities, but quite a key difference is that the non-residents don't have a tax-free amount. They don't have a tax-free amount there. So each and every amount there is taxed there. So a little bit less favorable therefore the taxpayers who will be deemed to be non-resident. Of course, we shall look at the criteria for determining residence and non-residence in our subsequent discussions. Quite an important aspect in determining taxation there. or tax rates, especially for individuals, but also companies. So that is our overview about income tax rates for non-resident. I must emphasize these are non-resident individuals. These are non-resident individuals. So the next slide, we look at income tax for companies. So that is stipulated in section 7, subsection 1 of this act. So it then states, I'll read in the verbative, the chargeable income of a company for a year of income, we looked at a year of income, which I must still emphasize, I won't get tired of drawing emphasis on this. The year of income may include a substituted year of income or a transitional year of income. So the chargeable income of a company for a year of income is charged to income tax at the prescribed rate in Part 2 of the third schedule. So what does Part 2 of the third schedule say? Part 2 of the third schedule says the income tax rate applicable to companies other than mining companies, so a bit of an exception there, for the purposes of section 7 is 30%. So income tax rate for companies in Uganda is 30%. So we are done with that. So then, what then follows? A little bit of a breather, there for us. We have a quiz, having looked at all these fundamental aspects of tax, income tax in Uganda. So we then have a quiz. So the first question, the year of income for an individual and a company must always be 30th of June. Is that, and the options we have are true or false? Well, if you've been part of our class, then it should be quite straightforward that the year of income is not all the time 30th of June. It may as well include a substituted year of income. So that's quite important for us. So that makes the first answer false. So there are a bit of exceptions. The second question there, the year of income for a company and individual are the same, true or false? Well, the year of income, that one, we need to, we can answer it together. So the year of income for a company and an individual are stated to be 30th June. So that is quite true, and it is stipulated in the Income Tax Act that the year of income must be 30th of June. That's the normal year of income. Of course, we also have a substituted year of income. So I think that is true. They're not given different dates there in the Income Tax Act. I think that's what the question meant to test, because it is stipulated as 30th June, so they are the same. Next question. An individual can change his year of income upon making an application to the Commissioner General. I think that one is true, but it's at the discretion of the Commissioner General. It is not a right. Those provisions are clearly stipulated under Section 39 of the Income Tax Act. So it is quite a privilege granted on satisfaction or at the discretion of the Commissioner. So our fourth and I think the last, this one, I think everybody should get it right, really. Each and every one of us should get it right. The applicable rates of income tax for companies can be found in which part of the third schedule of the Income Tax Act? We have Part 1, Part 2, and Part 3. And if we have been together, then you must realize that Part 1 and Part 3 are distractors. Part 1 were the rates for individuals, and therefore Part 2 is the rate for companies. We haven't looked at Part 3. So the answer there is Part 2. So I'd like to thank you very much for listening to this session from the beginning to the end. My name is Norman Enyang. As I said before, I work as a tax consultant with Layton Meridian. I also produce lots of videos for taxation, especially in Uganda there. So thank you so much. Would like to encourage you, if you like the video, you can subscribe to our YouTube channel so that you can get these messages instantly as they come. Another important thing you can do if you need us to cover specific areas of taxation in Uganda, you can also post to us, especially in the comment section of this video. That's also quite welcome, especially with the continued amendments and different changes that come in our tax law. So we continue our pursuit to support you in having a strong grip and understanding in this extremely dynamic and robust world of taxation. Thank you very much indeed. Thank you. Thank you very much indeed for listening to the video.